Best Bear Market ETF Investing Strategies and Key Takeaways. Part 6 of 6. What if the best investing decisions you'll ever make happen when the market is falling? Not when stocks are hitting new highs, not when everyone is celebrating, but when fear is everywhere. That sounds completely backwards. Most people think bear markets are something to survive. Successful investors often see them as opportunities to prepare. Welcome to the Simply Speaking About Money video channel. It is here where we talk about budgeting, saving, and investing in the real world of probabilities, and not the crazy hype, noise, and lottery-like promises of possibilities. Here's the problem. When markets fall, many investors suddenly forget the plan they spent years creating. They stop investing. They sell good investments. They start searching for magical solutions on the internet. Because clearly, a stranger with a microphone has never been wrong before. Fear has a funny way of making bad ideas sound reasonable. Even intelligent people can make emotional decisions when money is involved. The result? Many investors sell low, miss the recovery, and spend years trying to catch up. The truth is that bear markets are a normal part of investing. They aren't glitches, they're features. Every major market decline in history has felt different at the time, but they all shared one thing. Eventually, markets recovered. That doesn't mean recovery happens overnight. Sometimes it takes patience. Sometimes a lot of patience. The kind that feels longer than waiting for customer service to answer. So what should investors actually do during a bear market? Let's start with the first strategy. Stay diversified. Bear markets often expose concentrated portfolios. The stock that looked unstoppable last year suddenly remembers gravity exists. Broad market ETFs help spread risk across hundreds or thousands of companies. Examples include VTI and VOO. Diversification won't eliminate losses, but it can reduce the damage caused by being heavily concentrated in one area. Think of diversification like wearing a seatbelt. You hope you never need it, but you're glad it's there when things get rough. Strategy number 2 is continuing to invest consistently. This is where many investors struggle. When prices fall, investing feels uncomfortable. Ironically, lower prices are often exactly what long-term investors should want. Imagine walking into your favorite store and seeing everything marked down by 30%. Most people would call that a sale. Yet when stocks go on sale, many investors run for the exits. Apparently, discounts are wonderful everywhere except the stock market. Consistent investing allows you to purchase more shares when prices are lower. Over time, that can improve long-term results. This is why many investors continue using dollar-cost averaging during bear markets. The process removes much of the emotion. Strategy number 3 is maintaining appropriate bond exposure. Bear markets remind investors why balance matters. Bond ETFs may help reduce portfolio volatility compared to an all-stock portfolio. Examples include BND and other broad bond funds. No investment is risk-free, but bonds can sometimes provide stability when stock markets become volatile. Think of bonds as the shock absorbers in a vehicle. You barely notice them when the road is smooth. You appreciate them when the potholes arrive. Strategy number 4 is avoiding performance chasing. Even during bear markets, investors search for the next miracle investment. There is always a new prediction, a new hot sector, a new guaranteed winner. The guarantees usually disappear right after the losses arrive. Successful investors understand something important. No ETF can eliminate uncertainty. The goal isn't finding perfection. The goal is building a portfolio that can survive uncertainty. Let's talk about defensive ETFs. Some investors choose to add exposure to sectors such as healthcare, utilities, or consumer staples. people still need medicine. They still need electricity. And thankfully, they continue buying toilet paper regardless of market conditions. Examples include XLV for healthcare and VPU for utilities. These sectors may experience less volatility than some growth-oriented sectors. That said, defensive sectors can still decline. Defensive doesn't mean indestructible. It simply means potentially less vulnerable. Another important bear market strategy is rebalancing. This sounds boring. That's because it is. And boring investing habits have a strange tendency to work surprisingly well. Rebalancing means returning your portfolio to its target allocation. You are essentially buying assets that have become relatively cheaper. Many investors want to buy low and sell high. Rebalancing is one of the few strategies that actually encourages exactly that. Here's an analogy. Imagine building a house. You don't abandon the blueprint every time the weather changes. You follow the plan because the blueprint was designed for all conditions, not just sunny days. Your investment plan should work the same way. Bear markets test discipline. Bull markets test patience. Long-term investing requires both. The investors who succeed are often not the smartest people in the room. They're usually the most consistent. The best bear market ETF strategy is surprisingly simple. Stay diversified, keep investing, maintain balance, avoid emotional decisions. Notice what's missing. No predictions, no market forecasts, no secret indicators hidden in a basement somewhere. Long-term wealth is rarely built through dramatic decisions. It's usually built through steady habits repeated over many years. If you remember only one thing from this entire 6-part series, remember this. Successful investing is about probabilities, not possibilities. If you found value in today's video, make sure you hit the like button and subscribe to Simply Speaking About Money so you never miss practical strategies that help you build wealth and make smarter financial decisions. Also, check the description box below for the financial tool we recommend related to today's topic. It's a resource we personally suggest because it can help you apply what you've just learned and take action immediately. Your support helps this channel continue bringing you clear, no-hype financial education. Now stay with us, because up next is a special bonus that can help you take this even further. If you want to see your entire financial life in one place, clarity is the first step. That's where Empower comes in. Empower gives you powerful tools to track your net worth, monitor investments, analyze fees, and plan for retirement, all in one dashboard. You can connect your accounts, see exactly where you stand, and make smarter decisions with real data, because what gets measured gets managed. If you're serious about organizing your money and building long-term wealth, check out the link in the description to explore Empower. Affiliate disclosure: I may earn a commission if you sign up using my link at no extra cost to you.